Onto some company news now. The Absa Group has not paid out a dividend, reporting a 58% plunge in overall profits. Like other lenders, the group has seen a spike in credit impairments. South African lenders have struggled with slow growth in fees and loans, as well as low interest rate cuts. Absa says the pandemic has changed client behavioral patterns. And joining me now to discuss this further is Jason Quinn, who's Absa CFO. Many thanks for your time this afternoon, Jason. So the results are a clear indication that the consumers are struggling. You've got the increased impairments, and I just want to know how this is going to be affecting your particular business as well as the industry as a whole for the short while.
Well, thanks very much, and good evening to you and your viewers. Look, I mean, 2020 was pretty unprecedented with respect to the havoc that the virus caused on the economy. Right through that, Absa's approach was to be there for our customers. We've firstly worked with the Central Bank and the Ministry of Finance and others to put resilience in our financial system. And then in the second quarter, when we realized how severe this was, we offered payment relief to our customers in the retail bank in South Africa. And it was interesting to see that almost 1 in 3 customers took that up, around about 150 billion rand of loans, where customers didn't have to make payments to us for 3 months. I'm pleased to say that into the third and fourth quarter, much of that relief matured to the extent now we're only providing relief to about 1.5 billion rands worth of loans. Of course, interest rates also came down dramatically, which provided its own type of relief to customers because their installments reduced. So Absa has navigated the crisis well thus far. Our earnings were down 51%, as you mentioned. More importantly, we use another metric called pre-provision profits. In other words, what would our profits have been if not for the bad debts that we booked? And we're so pleased that that came out as 7%, which is market leading, in fact. And that's the difference between our revenues and our costs. And it shows a customer franchise that's in reasonable health. We think the worst is behind us with respect to bad debt provisions. We've booked significant provisions that will stand us in good stead in future years that we'll be able to utilize if delinquencies materialize. And in fact, in the second half of last year, our bad debt charges came down substantially from the first half. And we guided today for 2021 also to have a reasonable outcome or a better outcome than what we had last year for sure. So there's lots still to look at with respect to forecasts and risks, but we believe we've been there for our customers and we believe that our results have come through this fairly resiliently thus far.
Right now, your competitors have gone through the similar pain with COVID-19, and yet some declared a dividend and you didn't do that. Tell us your rationale and the guidance that you are giving your investors when it comes to the dividend policy.
Thanks so much for that question, Rafia. We were very consistent right from our interim results in June, where we didn't declare an interim dividend, and then we guided twice last year and once a few weeks ago that it remained our position that we weren't going to declare a dividend for last year. And thus there was no surprise today when we didn't do so. The logic behind it is fairly simple. Our capital is strong. It's well above board target range, minimum requirements. We've got sufficient buffers in place. All we're saying is right now it's probably better to be focused on preserving capital. We see some risks ahead of us, particularly in the next quarter in South Africa, where there's likely to be a third wave of the virus hitting, which could cause further distress in the economy. So we thought to retain capital at this point was the right thing. However, we did say to investors that based on our outlook, we're generating capital quite quickly and we're improving our ratio. We expect to improve our capital ratio this year even further, such that we should be able to declare a dividend in the first half. And then furthermore, we said that, look, we do also retain some capital for targeted growth opportunities. Absa has been lending again in mortgages and vehicle and asset finance quite selectively. So to the extent that growth is there, we would obviously like to use our capital to grow to the extent it's appropriate and responsible. And should we be in a position where we end up with too much capital, we could, of course, pull other levers like declaring a special dividend or a share buyback at some point in time. But as for last year, given the reduction in earnings and given the priority of preserving capital and keeping our balance sheet absolutely resilient, it was appropriate for us not to declare a dividend for last year.
We've run out of time, Jason, but I have to ask you, the passing of Peter Matlare and the gap that has been left, what does this mean in terms of leadership for the African operations?
Yeah, look, thanks very much. Of course, it's a devastating loss for us to lose a colleague and friend. It's only been a week since he's passed, so we'll make further announcements on that in due course. We'll never replace Peter. We'll probably have another person doing that job.
No, absolutely, and we wish you the very best of luck in terms of getting that new person and continuing to grow your footprint across the continent. That is, of course, Jason Quinn, who's ABSA CFO. Let's take a quick